Welcome to our deep dive on maximizing tax-free retirement growth using Roth 401k, Backdoor Roth IRA, and the Mega Backdoor Roth. In this video, we'll clarify how these tools differ, when and how to use them, and common pitfalls to avoid. We'll use decision diagrams, timelines, and quick quizzes to lock in your understanding. Let's begin. First, I'll outline how the strategies differ at a high level. Then we'll review each one in detail. Next, we'll compare them with a decision flow and cover actionable steps, contribution limits, and timing. Finally, we'll reinforce your learning with quizzes. Let's move on to a brief but important disclaimer. This content is for educational purposes only and is not personalized financial, tax, or legal advice. Rules and limits change. Verify with current IRS guidance and consult a qualified professional before acting. Now, with that out of the way, let's get the big picture of how these strategies fit together. At a high level, all three strategies aim for tax-free growth in retirement. However, they use different pipelines. The Roth 401k uses post-tax salary deferrals, but shares the elective deferral limit with the traditional 401k. The Backdoor Roth IRA relies on making a non-deductible traditional IRA contribution and quickly converting to a Roth IRA, but may be impacted by the Pro-Rata rule if you hold pre-tax IRA balances. The Mega Backdoor Roth uses after-tax contributions to the 401k beyond the elective deferral limit and converts them to Roth, either in-plan or via in-service rollovers, subject to plan features and testing. With this overview in mind, let's first clarify the Roth 401k. The Roth 401k takes after-tax contributions and allows tax-free qualified withdrawals. Critically, the Roth and traditional 401k share the same elective deferral limit, roughly $23,000 per year, with an additional catch-up for those age 50 or older. Employer matches typically land on the pre-tax side. In general, Roth 401k shines when your current tax rate is equal to or lower than what you expect in retirement. High earners often prioritize pre-tax first to reduce current taxable income, which can limit space for Roth 401k contributions. Next, let's move to the Backdoor Roth IRA strategy. The Backdoor Roth IRA is a workaround for high earners who exceed income limits for direct Roth IRA contributions. You contribute non-deductible dollars to a traditional IRA and then convert those funds to Roth IRA as soon as possible. The contribution counts toward the annual IRA limit, which is separate from any 401k limits. The key risk is the Pro-Rata rule. If you hold pre-tax balances in any traditional, SEP, or simple IRA, your conversion will be taxed proportionally. You must also file Form 8606 to report and track basis. Now let's supercharge the concept with the Mega Backdoor Roth. The Mega Backdoor Roth uses after-tax 401k contributions beyond the standard elective deferral. If your plan allows after-tax contributions and either in-plan Roth conversions or in-service distributions, you can convert those after-tax dollars to Roth quickly, aiming to minimize earnings before conversion. This strategy can enable significantly higher Roth funding compared to either a Roth 401k or a Backdoor Roth IRA. However, it depends entirely on plan rules and may be constrained by non-discrimination testing. With the mechanics covered, let's compare Backdoor Roth IRA versus Mega Backdoor Roth directly. Comparing the two. The Backdoor Roth IRA is limited to the IRA contribution cap and is independent of your employer's plan, but it's affected by the Pro-Rata rule if you hold pre-tax IRA dollars. The Mega Backdoor Roth can allow a much larger Roth contribution because it leverages 401k after-tax space, yet it requires supportive plan provisions and may face non-discrimination testing constraints. If your employer plan is robust and you need more Roth capacity, the Mega Backdoor can be compelling. Otherwise, the standard Backdoor Roth IRA offers a simpler, universal route. Next, let's guide you with the decision flow. This decision flow starts by securing the employer match, which is typically the highest return action. Next, it asks whether you value the immediate tax deduction, leading toward traditional 401k, or prefer Roth deferrals. After the elective deferral decision, the flow checks whether your plan allows after-tax contributions and Roth conversion paths, enabling the Mega Backdoor Roth. If your plan does not support it, the flow suggests the Backdoor Roth IRA, including a check for the Pro-Rata rule. This structure helps prioritize actions logically. Now let's anchor the numbers with a quick limits table. These numbers are approximate and may change. The elective deferral limit for 401k contributions is shared between traditional and Roth 401k. After-tax 401k contributions for the Mega Backdoor Roth are constrained by the overall plan and IRS limits and require specific plan features. IRA limits apply collectively to traditional and Roth, and the backdoor strategy routes around income limits by using a non-deductible traditional IRA contribution followed by a conversion. Always verify the latest IRS figures before executing. Next, we'll walk through step-by-step instructions. To execute a backdoor Roth IRA, first confirm that your income exceeds the direct Roth IRA contribution limits. Next, verify you do not hold pre-tax balances in any IRA types, or consider strategies to isolate or move those balances. Then, contribute non-deductible funds to a traditional IRA and promptly convert them to a Roth IRA to minimize taxable earnings. Remember to file Form 8606 to report your basis and the conversion. This can be repeated each year. Now let's outline the Mega Backdoor Roth steps. For the Mega Backdoor Roth, begin by maximizing your elective deferrals and capturing the full employer match. Confirm that your plan allows after-tax 401k contributions and provides a path to convert, either in-plan Roth conversion or in-service rollover to a Roth IRA. Then contribute after-tax funds up to what the plan and IRS allow, and convert frequently to keep earnings minimal. Maintain clear records to distinguish pre-tax, Roth, and after-tax sources. Next, let's test your understanding with a quick quiz. Question: which statement best describes the relationship between Roth 401k and traditional 401k contribution limits? Options: A. They have separate elective deferral limits. B. They share the same elective deferral limit. C. They are unrelated. Limits vary by employer only. D. Roth 401k has no limit if you have a match. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that they share the same elective deferral limit. Contributions to Roth 401k reduce the available space for traditional 401k and vice versa. Question: what triggers the pro-rata rule in a backdoor Roth IRA conversion? Options: A. Having any pre-tax balances in traditional, SEP, or simple IRAs. B. Having a 401k with employer match. C. Contributing more than the IRA limit. D. Rolling to a Roth 401k instead of Roth IRA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that pre-tax balances in traditional, SEP, or simple IRAs trigger the pro-rata rule, causing part of the conversion to be taxable. This timeline shows a practical cadence. Early in the year, confirm last year's Form 8606 and plan contributions. In the first quarter, execute the backdoor Roth IRA by making a non-deductible IRA contribution and converting promptly. For Mega Backdoor Roth, contribute after-tax amounts and convert at a monthly or quarterly rhythm to minimize earnings. In the fall, verify progress against limits and plan for year-end. In December, finish conversions and reconcile records. In January, confirm tax documentation for the prior year. Now, let's visualize how your total savings might be allocated. This pie chart depicts a hypothetical allocation for a high earner, a significant portion to traditional 401k for immediate tax savings, a slice to Roth 401k for diversification, a large after-tax 401k segment for Mega Backdoor Roth conversions, a backdoor Roth IRA component, and an HSA slice if eligible. Your actual mix will depend on your tax rates, plan rules, and goals. To wrap up, let's summarize the key takeaways in a quick checklist. The key ideas are: Roth and traditional 401k share a single elective deferral cap. The backdoor Roth IRA uses IRA space and is sensitive to the pro-rata rule. The Mega Backdoor Roth requires plan features but can greatly expand Roth capacity. Always secure your employer match first and then optimize the order of tax strategies. Keep diligent records and file the necessary forms. Here is a concise, Markdown-styled checklist to order your actions. First, secure the employer match. Second, decide between traditional and Roth 401k based on your current and expected future tax rates. Third, if eligible, Leverage after-tax 401k contributions with frequent conversions for the Mega Backdoor Roth. Fourth, use the Backdoor Roth IRA each year for additional Roth capacity. Fifth, track basis using Form 8606 and keep thorough records. Sixth, revisit your plan annually as circumstances and rules evolve. Finally, we will close with a brief summary and a call to action. In summary, these are distinct tools with unique rules. Prioritize your employer match. Then choose the right mix of traditional versus Roth 401k. Consider the Mega Backdoor if your plan allows, and use the Backdoor Roth IRA for additional Roth space. Recheck plan documents and IRS limits annually, and consult a professional for personalized advice. One final note before we close. Thanks for watching. If this video helped clarify the differences among Roth 401k, Backdoor Roth IRA, and Mega Backdoor Roth, please like, share, and subscribe. Tell us in the comments what your biggest Roth question is, or which strategy your plan actually supports. See you in the next video.